trust your crypto assets to centralized exchanges that actively sell your private information and front-run your trades? Would you like to buy and sell your assets without any middlemen, intermediaries, or robots? Do you like paying slippage, fees, and having the price go up as bots steal from you on low-liquidity decentralized exchanges? The solution is NodeMarket.io. Set your guaranteed buy or sell price. No middlemen, no slippage, no bots, ever. Buy or sell 1, 10, or even 10 million tokens, and you never have to worry. OTC trades are between you and the seller or buyer, guaranteed by audited smart contracts and no human middlemen. NodeMarket.io. Do you trust your crypto assets to
Whoa,
centralized exchanges that
whoa.
actively...
That guy just want to keep going. I guess we paid him double time. I think we nailed them all. I think we nailed them. All right. Get this on sound. Okay, so before we get to the news, the crypto news, the stuff, and before we go into, we're going to have a deep discussion about market making, so that everybody knows exactly what that's all about, because it's a pretty sketchy business. It's important, but it's incredibly sketchy. And there are good market makers and there are bad market makers. A bunch of them got indicted last week. So I thought we'd talk about it a little bit more in depth. So we're going to go deep into, that's funny. We're going to go deep into market makers, what you can and cannot do. Okay, let's see. A quick piece of news that you guys saw. Okay, so the Singularity, the Singularity DAO, their new venture is they're combining Cogito, a worthless company with worthless people, and Singularity DAO with SafeKey, and doubling the token supply. Just because, why wouldn't you double it? Why wouldn't you double the amount to 50 billion tokens? I mean, why would you not? That seems kind of par for the course for those kinds of things. And then they're going to make it into a layer 2 because, you know, layer 2, everybody's got a layer 2 now. So why shouldn't Singularity have a layer 2? Is anybody there? Does anyone there know anything about programming? Anything beyond what you can do on GPT 4? No. Is anybody there have any skill in working with Solidity contracts? Absolutely not. Does anybody there know about the security concerns of launching a layer 2 against a layer 1? Nope. Does anybody there have any experience with what? Nope. I mean, Mario, he's going to code the layer 2 because of Ethereum. It's so stupid. I listened to that dithering. They did an X Spaces, Twitter Spaces, SpaceX, X Spaces. Oh, I get it. Anyway, they did a Spaces thing, and it was the usual. It was the usual thing. It was Mario stuttering like Stuttering Stanley. It was Chloris making excuses for doubling the token supply to an astronomical amount. None of them discussing that they're technologically incapable of doing this, other than just forking some other project. They'll just fork some other project. That's what this is. It's another cash grab kind of a thing. They couched it in this idea about what was it? There was a bunch of BS, but part of it was, you know what? It doesn't matter. It doesn't matter. It was just really stupid. Then Mario said, well, so then what's next? He goes, well, we're going to repackage and relabel and rebrand Singularity DAO. So they're just going to relaunch another Singularity DAO token, but they're going to call it something different. It's so stupid. I thought it was a joke. I thought it was a practical joke, but then Ben was on the Twitter Spaces making excuses. He's like, I mean, it's the typical stuff. Hey, people might say that in crypto, you shouldn't do this or you shouldn't, but who knows? I mean, crypto is a crazy space, and basically just a bunch of weird dithering, just non-committal stuff. It was just, it was really bad. Oh, but it was funny. Because I thought at the end, I was like, they're going to say April Fools or whatever is the European equivalent. It's clearly this is a joke. It's not real. They wouldn't really do that. It's real. Apparently it's real. Oh my God, it was good. Oh, it was good stuff. I needed a good laugh yesterday, and I got a lot of them. So I'm feeling good. I might not even drop an F-bomb today. I don't know. I might, but I might not. So I did read some cool stuff. Oh, real quick. Do you know that there's like a legit superhero running around London? An actual superhero. Do you want to know what he does? He has one of those like handheld grinders that cuts through metal. And he runs around, and when the police boot cars, like for parking violations, where you can't move until you pay the fee, he goes and he cuts the boots off and then just throws them on the concrete. And he has a cape and like knee pads. He's like dressed like a superhero. It's like kind of gold and fringe and stuff. He's like a legit parking boot superhero guy. And then there's another one in England who dresses like Spider-Man and goes out at night and feeds homeless people, which that's pretty cool. So like, apparently in England, they have real superheroes. No, none of them are strong. Oh, there was another guy that he got attacked on his bike or something like that. Or maybe he got hit by a car on his bike, like a hit and run. And then now what he does, he has like a suit and armor and all this. And he goes out and tries to keep people from speeding and parking illegally. Like, I don't know. That just sounds like that just sounds like a cop, like a parking cop. But anyway, he's like a citizen parking cop. So he's not as cool. But the guy that cuts off the boots, that guy's cool. Anyway, so just so you feel a little bit better. Oh, Barry, which superhero would I be? Well, I'll show you. Hold on. No one, only my girlfriend has seen my superhero costume. Hold on. Let me put it on. I got to put on my costume. You can't recognize me, can you? Well, if you do a crime and I'm around, if I can fight that crime without using my hands, there you go. But I can't give away my identity. Hold on, let me take back off my costume. Whew. Anyway, I hope that nobody here will share that, because I don't want people to ever put us together if there's a whole rash of crimes that get solved in Los Angeles. I'm not saying I didn't do it. Anyway. Oh, that's kind of cool. Yeah, I wouldn't be a superhero because I don't have any powers, but I'd be like a superhero agent. I'd be like, look, if you want to book my guy, it's gonna cost you. I get that sweet 15%, baby. That sweet 15. Sign me up. Okay, does Hypercycle have a first mover advantage for AI compute? Okay, really quick. I want everyone to keep this in your mind. Hypercycle doesn't do compute. This is the beauty of Hypercycle. It's an infrastructure play where when people are using compute, you simply plug into Hypercycle and you get way more out of it. And there's a couple of different ways you get way more out of it. One way is you get to leverage other entities. So let's say you're a business and you use compute a lot. You make tons and tons of calls to these large language models and all this kind of stuff. You can plug in and you'll get more out of it, because there's a lot of times where that call doesn't need to be an expensive call to OpenAI or an expensive call to XYZ. It can be a much less expensive call somewhere else, right? Because all of these models and algorithms are floating around out there. You just have to know how to plug it, how to plumb them. So it would be access to lower cost compute that's already flowing. That would be one version. Another version, you are a company that provides a compute kind of resource, but it's limited in scope. Like a shop that produces some spices to use this analysis. You make some spices and you sell them to a restaurant chain. And then Hypercycle comes to you and says, hey man, you know, there's an internet out there. You could sell your spices to everyone on the planet. And they're like, whoa, really? Yes. So you could plug in that way, where your algorithm or your software could be available to a whole new group of people that you never even knew existed, right? All these people hungry for very different, and all this happens at the millisecond level, like really, really fast. These are like, I need 10 milliseconds of this, 20 milliseconds of that. So little things happen and little fees are exchanged. Okay. And so there's a lot of ways that what happens is essentially compute is happening. People are purchasing compute and people are offering up resources for compute. Hypercycle can sit in the middle of all those transactions, rerouting things, making it faster and cheaper and more efficient. It can be enriching entities that have cool software and tech, making them more money. And we're just basically a little gatekeeper, a toll bridge. Ding, 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 ding. Just little fees, little tiny, consistent, seemingly insignificant fees, but that reduce stress and cost by 60, 70, 80, 90%. And while you as a participant in this from the node license perspective, you have your node license, you're participating, you plug it into some hardware, or you offer that to someone else that has hardware, whatever deal you guys make. These transactions are pounding across your node, which is building your score, the society's ability to rely on your node based on a score, right? Like when you go to Yelp or anywhere else, you see the score. Oh, it's a 4.3. Oh, this one's a 3.1. We're not eating there. So you're building your relevance among the community. You're validating, as your validation score goes up and it approaches that threshold of 2, where you have compute and uptime and this kind of relevance score and all this kind of stuff. As you get to a 2, it means that you're getting now twice as many requests to use your node. And so boom, then it would split. So what's happening is, no matter how you play it, you're generating, by participating, you're generating higher and higher score that that unlocks more licenses, essentially more nodes. And as that happens, the value of your total little business starts to expand logarithmically, at least for several logs, up to 10 divisions, which means a node becomes 1,024 nodes, each with one token, one hypercycle token. Now, to also separate, the Ethereum hypercycle token is just a placeholder token. It's just a placeholder. It unlocks, once married to a license, it unlocks the native token, which bangs around really, really fast. And that's actually what grabs the data and moves it and then comes back with a little fee. So there's a little bit there to kind of unpack. And there's a new website that they've designed that's gonna explain all of this stuff a little bit easier. And they're putting a lot better FAQ and all that kind of stuff. So this will be a lot easier to get to kind of wrap your mind around. Now, to the question, does Hypercycle have a first mover advantage? Well, everybody kind of has a first mover advantage because we're not even in the first inning yet of AI. We're still kind of warming up. So I think I don't know anybody that's directly competing. Well, look, no one else has TOTA IP. No one else has the IP that Hypercycle has with this ledgerless blockchain features. So short of someone else inventing another version of that, which, maybe, there's lots of different blockchains, so I'm not saying it's not possible, but this is stuff they've been working on for, over a decade. And it's protected intellectual property. And no, they're not giving it away to Singularity Net to go squander. So I'd say they have about intellectually, they probably have about 5 years on everybody else intellectually. Now, again, that doesn't guarantee that everything rolls out smoothly. They had planned on compute already being rolled out by now. They wanted to roll that out in March. But they, as you roll these big software products out, it sometimes unearths other issues. And you're like, well, their biggest issue was engineers can do this, but regular people are going to have a really hard time doing all of the plumbing. So they need to build some tech, some software, some other ancillary bits and pieces that makes it easier for people like regular people to plug in and participate. Because if regular people can't do it, I ain't going to cut it. So they started working on Aimifier and some other bits of software and clearing up some technical debt and stuff like that. So there's a lot going on that you don't see to make it easier for everybody to participate. And that's also something that they would have an advantage on, because other companies might be working on one aspect of something similar to this, but maybe not all of them. And the other thing too is there's only so many really smart people. Like, I'm not a particular fan of Ben Gortzel, but he's a genius, right? Like, I don't have to like all of somebody to respect them. I don't like all that I see about Elon. I think he's kind of a weird megalomaniac, narcissistic piece of shit. But he's important for humanity. He's needed. Like, humans need guys like that will just push and push and push. And it is what it is. So there's just not that many people like that. So there's not that many Toofies and Bens and Dans and stuff like that. There's just not that many of them. So, you got to keep that in mind. There's not an unlimited now. Well, unless we, fast forward 5 years where we have like, AGI that's just better than us at everything. And that's a different kind of future. And we don't know what that's going to look like, because we don't know what happens when everything and everyone is smarter than we are. But until then, I would say that Hypercycle has a pretty big lead on everyone else. That's my gut feeling. All right. Have you looked into materials that will enable AI compute hardware, particularly gallium nitride chips? I have not. I have not. I thought you were saying GANs like adversarial networks. No. I'm not in the rooftop. I'm inside. I'm on the other side of the kitchen. If I look, so normally you guys see me. I like have the refrigerators behind me. I'm in the other direction. This is usually the background when I'm over there. That's all. I'm in the kitchen, bro. I'm just chilling in the kitchen, Howard, with this fine coffee. This one is Dolce de Leche. And it is sweet, sweet goodness. Okay, let's get to the news. It is a big window. I got big windows, bro. I always told myself when I grow up, I'm going to have big windows. They're going to be so big, it's going to take me a week to clean each one. All right. Let's talk the surge. Surge, not the Sarge. The surge. So Vitalik Buterin, our buddy Vitalik, he's apparently he woke up one morning and he decided he was going to participate again. So he got that big fat microphone that looks like a little satellite orbiting a giant orb planet, his head, and he said, it's time to make a change. So Vitalik Buterin envisions the surge. And this is the Ethereum roadmap offering, and I quote, 100,000 transactions per second. Woo! I think it's like 14 a second right now is what Ethereum kind of clocks. But anyway, the surge aims for 100,000 TPS to enhance network capacity and interoperability. And he's trying to have this achieved over layer 1 and layer 2 networks and have the layer 2s more better cooperate. Layer 2s that have nothing to do with Singularity DAO, by the way. Real layer 2s, because I guess there's a whole way you could unpack all that stuff. And anyway, whatever. Vitalik Buterin emphasizes interoperability and a unified layer 2 ecosystem as long as those layer 2s meet certain standards. The ETH price has been relatively positive in the last, week, 10 days. But I think people like this idea. Recently, he detailed the surge as an integral part of the evolving roadmap designed to expand the network's scalability and transaction capacities and capabilities. This segment of the development strategy seems to implement changes that will enable the blockchain to process 100,000 transactions per second, addressing the longstanding scalability dilemma facing blockchain technology and specifically facing Ethereum. Talk is cheap. I know, but I think he feels embarrassed by the success of these meme coin layers. Like, if these guys had tackled this 2 years ago or a year ago, would there be a Sui? Would there be an Aptos? Would there be ... Probably not. He kind of left the door wide open. And for whatever reason, Charles Hoskinson, with an obvious opportunity, didn't feel like this was something he could solve. So anyway, on his X account, he set out an ambitious roadmap for Ethereum to significantly enhance the network's capacity. And we talked a little bit about this a few days back, where we're talking about that he wants to go from, right now it requires 32 Ethereum to be locked up to be for staking directly. Whereas he wants to reduce that number to 1. And he wants to reduce the transaction finality from, so many minutes down to, a few seconds. So the surge phase of Ethereum's development focuses mostly on network decentralization and security, and getting its transaction throughput up over to or over 100,000 transactions a second. And this is critical as they compete with new blockchains to offer higher speeds and lower transaction costs. Really, it's a lower transaction cost situation. If you have really high speed, if you go really fast and really cheap, apparently people don't care that most transactions crash or that a lot of transactions crash. Like with Solana, a lot of transactions fail. I mean, a lot. And the network goes down all the time. And guess what? No one cares. I mean, it's still way better than the legacy system. And I guess that's where people are at. Like the Uber drivers that are spamming their tips into meme coins, telling everyone that they're financial advisors on the side. They don't give a shit if it's down for 15 minutes or 2 hours. They don't care, which is weird. But the IQ in the tech in tech has dramatically lowered as crypto and AI have started to swallow up parts of the world. But anyway, this is cool. According to Vitalik, introducing data availability sampling and enhancements in roll-up technology, think optimism, is central to achieving these high transaction rates. Data availability sampling will reduce the amount of data that each node needs to process. So this will increase the network's overall capacity without compromising its decentralized nature. And again, decentralized in the way consensus is achieved. Don't think about where the nodes are, who owns, like right now, Lido or whatever owns most of the node, does most of the validation, like almost a third of the whole network. And you would say, well, that doesn't seem super decentralized. Yeah, remember, governance is a separate. We're just talking about how transactions are achieved and the speed with which a transaction can process, not what happens after the fact or the cost that it would take to pervert the network or to be Byzantine, right? So, what he also said was that growth and development of trustless rollups will guarantee that layer 2 solutions provide as much security as the Ethereum mainnets. Part of the problem is that you get people that are not super skilled building these layer 2s, basically just grabbing someone else's code, just changing some ones and zeros and making it their own and then saying, I'm launching a layer 2. I think everyone here should launch a layer 2. Well, why would we not? Why would we not all launch a layer 2? And I'm not going to have just 50 billion tokens. No. I'm going to have 50 trillion. Screw that. I'm going to have 50 quadrillion tokens. Every time you breathe, tokens are going to go in and out of your mouth. You won't even see them. That's how many tokens I'm going to have. Anyway, on my layer 2. Additionally, Vitalik called for increased integration of launched, not going to launched layer 2 protocols built on Ethereum. This would bring about a single point contact associating the users with a totally integrated system. Further, interoperability will mitigate the complexities that may arise from the flow of assets from one layer 1 to a layer 2 to another layer 2 back to a layer 1. And so what he said was basically, if we're serious about the idea that layer 2s are part of Ethereum, then we need to make using the layer 2 ecosystem feel like using a unified Ethereum ecosystem. We've been saying this for freaking years. It needs to just be one experience, one wallet. I need to buy, sell, or swap this for that. Everything's really a swap. Buying or selling is a swap. You're swapping X for Y. Y might be a stable coin. X might be a stable coin. Why not? So everything's a swap. I shouldn't have to go to 14 different networks and use gas from here and there and everywhere else. I should have one wallet to do all my shit. One wallet. All my shit. Why do I have to go, the gas and the thing, the different deal? No. One wallet, man. So anyway, there we go. So this integration of layer 1 and layer 2 networks in Ethereum aims to provide a seamless, scalable, expandable blockchain system. Therefore, it would, you would imagine, enhance easy use and lower IQ users and make it less stressful for those of us that don't have a low IQ. This would be good for attracting new customers. It would be good for going into places that are not tech savvy, where people are not used to using, very few people are used to using, Web3 wallets, things like that. The on-ramp is quite dramatic and people make mistakes all the time. So if you could ease that educational burden, that on-ramp stress, I think that'd be great. So anyway, here, Ethereum woke up this morning and he chose violence. I mean, evolution. Now, is he going to write any code? No. But he is going to saddle some guys with a bunch of code to be written, and that's cool. Okay, slight gear shift. Let's talk about U.S. Bitcoin ETFs. Oh wait, let me just get rid of that. Let me go to banners. Do some clever stuff. So we talked about that. It would be cool if it just went away, but this isn't like that cool of a show. All right, let's talk Bitcoin ETFs. U.S. Bitcoin ETFs reach record high with 950,000 Bitcoin in assets under management. So 11 of the spot United States-based ETFs for Bitcoin now hold 950,000 Bitcoin. Holy smokes. Seems like a lot, right? Almost a million. Remember, it was only 21 million, 6 million lost. Okay. Anyway, the 11 U.S. spot exchange-traded funds now hold more than 950,000 Bitcoin worth of assets under management following massive inflows of funds. Head of research at K33 shared data on Twitter, noting that the current assets under management marks an all-time high for the ETFs. And if you don't believe me, bub, guess what I've got? I got a damn chart for you. What? That's right. Let me move this little thing. Hell yeah, I've got a chart. Hey, and I'm going to read more about it. Over the last 3 days, between October 14th and 16th, spot Bitcoin ETFs have seen over 1 billion in inflows. Leading the inflow is BlackRock's IBIT, which recorded 761.7 million in inflows within that period and accounts for almost 70% of the inflows. Oh man, I so hope that that Grayscale didn't go negative. I come on, man. I don't like Grayscale, but just do me a solid, universe. Let's just have one day. Let's just have one day where there's no Grayscale outflows. Okay, here we go. Other spot ETFs like Fidelity, Bitwise, and ARK also recorded significant volumes of 289 million, 113 million, and 96 million respectively. These three ETFs have also enjoyed 4 consecutive days of substantial inflows as they recorded a combined 253.5 million of inflows on October 11th when BlackRock had zero flows. That's not zero flows. I think BlackRock manages their flows. They reconcile the flows there's no such thing as zero. There's somebody sold one or bought one, somebody. So when I see zero, I think there's some management going on. Anyway, it's not painting the tape, but they're definitely managing it. With most of the ETFs seeing inflows on October 16th and none reporting any outflows, only Wisdom Tree and Grayscale finished the day with zero flows. They didn't get zero. They probably got negative, and they're reconciling over a few days period. How is that? Just think about that for a second. Okay. Everybody, real quick. $1 billion comes in to ETFs, and Grayscale is flat. They're the only one. We didn't make any money. Did you guys make money? Did that guy pay you to mow the lawn? I did it for free. Really? That's a good question. Because it's apropos to this discussion. Would you include investment in the ETF? Yes. So if you had like a retirement fund or a whatever, and you had some percentage there, you'd have to equate it to Bitcoin, probably dollar wise. I don't know how you directly correlate. I mean, I'm sure there's some math on there about what every dollar invested in these ETFs equals in terms of actual Bitcoin, although you can't reverse it and get out Bitcoin. But yeah, I would say that also counts. 23% Bitcoin, 15 ETH. That's not bad. It's not bad. I mean, we're not talking about advice, but I'm not giving you good or bad advice. I'm just saying it don't look bad. It don't look bad. Okay. So yeah, I would add that. Yeah, I would add that in your portfolio. You have exposure to Bitcoin, so it's fair to say. Okay. BlackRock's IBIT has 22.4 billion in inflows, followed by Fidelity's FBTC with over 10 billion in positive flows. Other issuers, Bitwise and ARK, have around 5 billion in cumulative flows. However, the impressive flows into these Bitcoin ETFs were impacted by Grayscale's GBTC, which has seen a net outflow of 20 billion. I'm not going to go into a whole thing about how Grayscale just dismantled their entire business, but they went from being someone that was important to being an embarrassment, and they did it really quickly. This time last year, Grayscale meant something, right? When you saw those commercials. Oh, by the way, those commercials on CNBC are a lie now. They said they're the biggest like Bitcoin assets. It's all bullshit. They're not the biggest because they just hemorrhage money. So I think someone should take them to task on that false advertising as I sip this damn fine coffee. Anyway, there we go. There's some other stuff that talks about comparing U.S. ETFs to other ETPs, exchange traded products. No one cares. People are buying Bitcoin, and that kind of jumps us to our next. I'm going to skip real quick and talk about the next Bitcoin story, which is, let me adjust the banner on this one, and that's I'm going to skip the A16Z report just for a second, and then we'll come back to it. But basically, Bitcoin is leaving exchanges real fast, and I'll just get you the basics of that. Essentially, Bitcoin reserves on exchanges have hit an all-time low of less than 2.7 million Bitcoin. I feel like the number, the oh shit panic number, is 1 million. When there is only 1 million Bitcoin left on exchanges, the shit is going to hit the fan. And I think there's going to be a real panic. And again, it's a panic of perception, but that's all panics, right? You perceive that something that makes you panic. I think that's the oh shit number. I don't think 2 million is a big deal. I think it's at 2.7 million. I think when it is 1 million, there is an oh shit moment. But according to CryptoQuant, which is a research facility thing, whatever, Bitcoin reserves on exchanges are at an all-time low, falling to less than 2.7 million Bitcoin. 3 years ago, it was 3.3 million, and that was the lowest at that time. So obviously there's a lot of growing speculation about the implications it may have for the market. Now, this data only goes back to mid-October 2021, so it's clearly not deep enough data to trade against. I would not do that, but it's interesting to keep in mind. So we'll see. Oh, also, there's a lot of Bitcoin that's still undistributed to creditors through Mt. Gox. They pushed back that date, the final date, which was supposed to be October 31st of this year. They pushed it back 1 year. I think 2/3 of it is gone, has been distributed, whatever. But I still think there's about 1/3 of that Bitcoin that has not been distributed. So a few tens of thousands still there. Babylon staking protocol recently opened additional deposits that attracted 1.4 billion of Bitcoins. That's Bitcoin that went away. And because there's these weird places where you can kind of stake Bitcoin and no one's really sure what that means and no one's really sure how safe that is. And I'm not going to be participating in that at all. But if I saw a safe version of this that maybe went through Coinbase or something like that, I don't mind handing Coinbase a few percentage points, kind of keep me safe. Anyway, that's That's what my gut feeling is there. So it's kind of interesting. So we'll see. Typically, you say, well, who cares about Bitcoin reserves? Well, typically when the reserves are low and there's less Bitcoin available, it creates more volatile markets, but does tend to increase buying pressure. So there we go. But again, you will get a lot of volatility because you have less of those units floating around. The price moves are bigger because buying the same amount of Bitcoin has a disproportionate amount of influence when there's less Bitcoin available. You guys get that. That's supply and demand, small e. Small e. Okay, so we got that nailed. I'll spend a few seconds talking about the A16Z report. I think I can just read the. Now, I didn't used to care what Andreessen Horowitz had to say. And by the way, this is not the same as Gavin Andreessen, the douchebag that was part of that Satoshi left the reins to with Bitcoin. This is not that guy. That guy's, in my opinion, kind of a dickhead, kind of a self-important schmuck. This is Andreessen Horowitz, A16Z, and it is a fund. These guys were very early to a lot of stuff, and they just they have their crypto report that they put out, and basically that some of the bullets are there's a significant surge in crypto adoption. No shit. Blockchain activity has surged to an all-time high, with Solana showing a dramatic evolution due mostly to meme coins. They're not talking about the technology, just the fact that you can't argue. A lot of people are using the Solana. Dummy's going to dummy, and it is what it is. So there you go. The number of unique addresses engaging with blockchain surged to 220 million in September. That's a lot. That's a lot of people banging around crypto. Is it the whole world? No. Is it the whole US? No. It's a lot. There are now 617 million global crypto owners and nearly 60 million monthly users. The base network leads the EVM, the Ethereum virtual machine, with 22 million monthly active addresses, while Solana is the top non-EVM chain with 100 million active addresses. Mobile wallet users have also reached a record number in 2024. That's dangerous, with the US accounting for 12% of global users. Newer blockchains like Near and older layer 1 networks like Tron and Bitcoin have seen increased popularity. Near has 31 million monthly active addresses, which is crazy because, I mean, I would say no one's using it, but I guess there's 31 million active addresses doing something. Tron and Bitcoin have 14 million, 11 million users, respectively. Ethereum has 6 million active users in September. However, A16 highlighted Solana as the blockchain with the most dramatic evolution. And this is just the biggest change. So the biggest change in total share of builder interest is Solana, specifically total share of founders who told us that they are interested in building on Solana grew to 11.2% this year. Well, yeah, of course, because these are people that have no experience in crypto and they want the easiest path to entry, and they're going to go build meme coins. So this is, good for them. Listen, building in the space is great. It doesn't matter if it's in scam, sham, garbage projects or good projects. If they're building in the crypto space, it's net positive, unless they're building sketchy stuff. Then in that case, it wouldn't be positive. But hey, they're still building, am I right? So, according to A16Z, the rising adoption of stable coins is a major factor in the crypto market's growth. Stable coin issuance, stable coin transfers, and use are apparently off the charts. And yet they have a chart. So anyway, the report also noted increased interest in using crypto in swing states like Pennsylvania and Wisconsin. Ooh, apparently their cheese it's just not enough. Good cheese is not enough. A16Z asserts that crypto has become a key political issue ahead of the election, adding that crypto research interest in these states has risen significantly since the last election. Unfortunately, not in Massachusetts, though, where if the world was smart, they would get rid of Elizabeth Warren. But anyway, you know what? She's going to be muzzled if Trump wins. So I worry not. Okay, so there we go. All right, what is left for us to discuss? Well, today we are going to do some brain work on market makers, and it is important to understand these guys serve a pretty dramatic function. It at first sounds like the whole thing should be illegal when we go over this, but I want to explain this so that you know that just because someone's a market maker doesn't mean they're dirty, but it doesn't mean they're not. Like the old angels with their wingtips dipped in blood type thing. But let's go on to our brain work. Let's talk about market makers. Let's talk about what you can and can't do, and let's get smart. So forget markets, forget money. Let me switch gears for un momentito.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
I like this one. This is a pretty cool. I mean, I think this is kind of a cool little. We talked about Ethereum today. Anyway, this is our background. Get you some background. Okay. So we're going to delve into the pretty critical role of market makers, both in equity and cryptocurrency markets. So I don't want you to think this is just a crypto specific sketch ass thing. It's a market specific sketch ass thing. So we're going to explore how market makers function, their importance in maintaining market liquidity, the legal framework that govern them, and the fine line between legitimate and illegitimate. You know, what are the market making activities and practices that swim or cross into the world of illegality? And a lot of this behavior you'll see and go, uh-oh, crap. A market maker is a firm or an individual that actively quotes both buy and sell price in a financial instrument. And so the idea is they're hoping to make a profit on the spread, the bid-ask spread. Their primary role is to provide liquidity to markets, ensuring that traders can buy or sell assets promptly. So if you're an exchange, you might want a market maker just to keep deal flow going, just so that people keep coming back to the exchange and doing stuff, right? So market makers in equity markets. Let's talk about equity markets first. They are a liquidity provision. They handle inventory management and risk management. So let's break that down. On the liquidity provision side, they facilitate trades. So market makers ensure that there's always a buyer and a seller, right? That reduces friction, right? Okay. And then on the bid ask spread, right? They profit from the difference between the buying price, the bid, and the selling price, the ask. So it would be the buying price, the selling price. And they profit from the spread because they're on both sides. Okay. You might think, oh, this is weird. It almost seems like that's not natural or inorganic. This is not natural. It is inorganic. The markets are not real markets. And you know how we say the price is always right? Well, sometimes the price is always right. There are no absolutes, I guess. Inventory management side, market makers, there's the balancing act, and then there's these obviously volume considerations. Yes. Bid, ask.
Hi, I'm the bid. This is what you buy it for. I'm the ask, and this is what I'm selling it for.
And I'm the market maker in the middle, and I'm going to eat it all up. You're like, oh, God. Anyway, so market makers on the inventory management side, they maintain an inventory of stock equity, right, to meet market demand, and they're adjusting positions in order to manage risk. On the volume side, higher trading volumes generally lead to tighter spreads, and that benefits both the market maker and the traders. Why? You say, well, they're getting less of a spread. Yeah, but they're getting it faster and faster and faster. So there you go. On the risk management side, there's a little bit of hedging, and then there's some regulatory capital requirements that they help to manage. So use of derivatives and other financial instruments mitigates risk from holding inventory of equity. So when you think derivatives, I'm not going to go into a whole derivative thing because that's a whole other thing, but think options, swaps, forwards, fasts, futures. Those are all kinds of derivative contracts. And again, that's a whole other discussion, like what are derivatives exactly. But a derivative is a proxy asset with or without leverage against an underlying asset. The underlying asset would be the real thing. And then these would be derivative products, right? Derivatives against that. So fast forward, future swaps, options. It's kind of an easy way to think about it. Or maybe that's not easy. Anyway, and another thing that on the risk management side, so they use derivatives to mitigate risk, right? Like you might use options to mitigate some of your cost risk. You might sell puts on an asset that you want to buy, or you might buy puts as insurance, or you might sell long dated out of the money calls to lower your dollar cost average price, things like that. Turn a non-performing asset into a performing asset, stuff like that. And then there are regulatory capital requirements, meaning a market maker must maintain sufficient capital to cover potential losses when they're banging around these transactions. Okay, so now we're starting to understand more what market makers do, right? And so there's legal and regulatory framework in equity markets. There's certain regulatory bodies, obviously, the SEC and FINRA, which is the Financial Industry Regulatory Authority. And FINRA, by the way, is the one that sets rules for broker-dealers, including market makers. The SEC goes after people that break the rules, right? Like they indicted, 4 or 5 market makers last week. We saw that whole thing in crypto from pulling shenanigans, and the FBI did that. That was the FBI because they made their fake coin, remember? Their FBI coin. Anyway, and then summarily exposed those wallets like a bunch of jackasses. Anyway, but FINRA makes the rules for broker-dealers and market makers. And so there are some obligations, and there's also some privileges. One is fair pricing. So market makers are required to offer reasonable bid and ask prices reflecting the true market value. That's tricky because how do you say what's the true market value? Well, they say. Who's watching them? Who knows? Supposed to be the SEC. Supposed to be. But we know that they have other things on their mind right now. And then transparency. Market makers must report trades and comply with market regulations to ensure transparency. Okay, so do they cross the lines into like market making turning into market manipulating, insider trading, and front running? I'm going to say they absolutely do. They absolutely don't get caught all the time. They 100% do it. 100%. I mean, they do it. You just saw a bunch of them get indicted. They absolutely do it. They push the boundaries and see how far they can push. And is this going to be one that gets us indicted, go to jail? Or is this going to be one that gets us indicted, pay a fee or a fine? If it's the pay a fine variety, they absolutely do it. If it's the go to jail one, they sometimes do it. But essentially, actions like spoofing or layering to create artificial demand and supply are illegal. Okay, and what is spoofing? Just so you guys know, is when someone puts up an order, like a big order, to make it look like there's a surreal amount of demand, and then they pull the order before it can fill, just because they're just trying to spook demand. And then there's layering, which creates you can put a whole bunch of orders together to make it look like there's a bunch of demand, and then tank those orders. And there's all sorts of perceived shenanigans. That stuff's illegal. Do they do it? They absolutely do it. Does it happen in crypto? All the time. I mean, all the time. Do people get in trouble? Not really. Anyway, insider trading. Mrs. Pelosi, are you listening? Trading based on non-public material information is prohibited. Do they do it? Well, no. They just call their friend or meet them for coffee and tell them to do it. Is it happening? Absolutely. It just is. So there you go. So yeah. Front running. And does this happen? Well, not only does it happen, Robinhood got caught obviously doing it. They didn't even deny it. They just did it. But especially when you have, matter of fact, Goldman Sachs got caught doing this, I think, several times. But essentially executing orders on a security for one's own account while taking advantage of advanced knowledge of pending orders that you might be pushing through your other accounts that you manage. So like, and this happens in crypto all the time too. People load up on options and leverage on one side or the other of their own trade that they're going to push through. And I know people think they're getting away with it right now, but AI is going to be able to do a lot of research and it's going to smoke out a lot of these dudes. There's going to be a lot of people that end up getting indicted that are doing stuff right now. Yeah. Anyway, it's not like there's no record of this stuff. This is like, I don't know why people think, oh, it's secret. It's nothing secret about a blockchain, jackwagons. Anyway, market makers in the cryptocurrency space. So there's a little bit less regulation. There's a little bit more volatility. There's some liquidity challenges, as you guys know. So cryptocurrency operates in a very much less regulated environment compared to equities. So there's a lot of different markets. It's hard to keep your eyes on everything. There is higher price volatility and varying liquidity across different cryptocurrency exchanges, which make things very weird and very sloppy. Like, did you do this, or was this just a machination of the markets? Blah, blah, blah. There are some similarities in their business operations, meaning they are still market makers are still used in crypto for creating essential markets, right? And efficient, like creating market efficiency, buy and sell orders. But the methods differ a little bit. And so what you have in crypto, you also have automated market makers, AMMs. And they use, well, they are supposed to use, this is the theory, is that they use algorithms and smart contracts in decentralized exchanges to facilitate trading. So when we talk about bot trading on the DEXs, automated market makers, bot trading. When people get in there and start massaging the numbers, you know, people that might do this and think that they can launch a layer 2 because they think that they're smarter than everyone, then maybe they get caught doing stuff they shouldn't do. And it's very obvious. Anyway, not to dither in that. Technology and innovation on that side, we're using blockchain-based technology or these distributed ledger systems. It enables new kinds of market making, such as liquidity pools, stuff like that, where it's market making is almost done through arbitrage. And cryptocurrency markets, unlike the stock market, they never close. It's 24/7, all the time. And that requires constant and continuous liquidity provisions, lots of liquid. And is there lots of liquid in a low liquid space? Well, no. So that creates weird volatility and weird distributions of assets, things like that. And things get blown up and things get cheated and then people use flash loans and take advantage of those weirdnesses. Remember, crypto is illiquid assets on illiquid exchanges being traded by sketchy ass individuals. And most of those individuals are illiquid too. Regulatory challenges. There are jurisdictional issues. So for instance, regulations vary quite widely in different countries in the crypto space, which creates a lot of complexity in jurisdiction, like who can go after who. Like, oh, like Justin Sun. Oh, no, I was in international waters. Ooh, can't catch me. They got CZ. Anyway, then you have the regulatory bodies like the CFTC, which is the Commodity Future Trading Commission, and the SEC are trying to be involved, but they don't even know which of them have jurisdiction because there's not a lot of rules. It's weird. Okay, then you have compliance requirements. So the AML KYC rules, which market makers must adhere to, and they never do in crypto. But they're supposed to adhere to anti-money laundering, know your customer regulations to prevent illicit activities. They mostly don't. In some jurisdictions, market makers need specific licenses to operate legally. They simply incorporate in the Bahamas and say that they don't, and then they just go until they get indicted. And so where does it cross the line into illegality? Well, we heard about this last week. This was a bunch of wash trading, which is illegally inflating trading volumes to mislead the market, and then, of course, dumping on them. So these coordinated efforts to pump and then inflate the price before selling off your holdings privately. And there was another market maker that did this: pumped the price of something, sold it off. They borrowed a bunch of tokens, pumped the price, then sold, dumped the price crashed. They bought the tokens back on the cheap and repaid their debt of those tokens. So I think Jump Trading got caught doing that. They're now being sued. Jump Trading is getting in a lot of trouble. Jump Trading is a sketchy entity. Just straight up. They're sketch as hell. So wash trading, which a lot of times creates pump and dump scenarios and schemes. And then that creates more regulatory enforcement, increased scrutiny, leading to fines and sanctions for noncompliance. Another pump and dump would be like, let's say you had a coin that no one cared about. I don't know. I'm just going to say, we'll call it Bogito. Bogito. We're just making one up. Bogito. And what are they? Well, it's a bunch of ex-bankers from, just let's say there's a bank called HSBQ. Anyway, they launched Bogito. Bogus, right? It's Bogito. Does it have any use, utility, or adoption? No. Nope. But why would it? It's bankers from HSBQ. They don't know anything about anything. So why would they be any good at crypto? Oh, they're not. So Bogito token all of a sudden goes from 2 cents to 30 cents. Well, that's weird. Well, how did that happen? Well, somebody got a bunch of people to come in and pump the price of Bogito on a small exchange. That price information propagated out so the people that owned Bogito could sell Bogito. Was this at all the work of society getting excited about these bankers from HSBQ or Bogito the project? No, it wasn't. Is this illegal? It's absolutely illegal. But in crypto, anyway, so that would be an example. And again, just pulled out of thin air. No relation to anything else. Just a random. The symbol would be BGV. If you know Bogito, BGV. And they specialize in fake world assets, not real world assets, fake world assets. So there you go. Just an example just pulling that out of thin air. Anyway. The ethical consideration side. So essentially, transparency and fairness. Probably you would hope that would mean something, right? So you can kind of uphold some market integrity. And the idea is to have some business practices that promote fair and efficient markets. I'm all for that. I think that these market makers need to be transparent about market making activities. You should know if you're in a market where market makers are participating. Like, it should be clear. There should be a little asterisk. A market maker is participating in this market that you are about to trade in, so that you know, right? So be transparent about market making activities. It could prevent conflicts of interest. Also, the market makers that are participating should be named. If you have a market maker running books for you or managing your liquidity, whatever you want to call it, it should be clear. And I should know who it is. And if it's Jump or one of these scumbags, I should know right then, that second. Anyway, we don't know these things because they don't really tell you these things. You just got to guess. Technology vigilance. So there are some algorithmic trading risks. And basically, you want to ensure that the automated strategies comply both with legal standards and that there's not some bull crappery in that code where the automated strategy is to pump the token so that they can exit and step on all of our necks on the way out, right? And then obviously some cybersecurity issues. I mean, you want to make sure that you can protect against hacks, unauthorized access, try to prevent flash loans, keep enough liquidity where people can't attack the liquidity pool itself. Be careful where you covet your information, your pricing information, so that someone can't go pervert some low rent exchange, whack the price, information propagates out, your exchange, the price is going down, and the price goes down, people they hit all the tenets of the flash loan, they crash the price of an asset, they buy it back on the cheap after having sold it, like a real quick pump and dump and repay, a short dump, pump, repay thing. Dump, sell, dump, repay. Yeah, you get it. So that's not good, and we don't want that. And then there should be continuous compliance, meaning that these market makers should be keeping abreast of changing regulations and ensuring that they are compliant. So we should know what they're doing. They should be compliant in what they're doing. There should be someone watching them. None of this is happening. It's barely happening in the equity space. It's definitely not happening in crypto. And low rent crooks, like the kind that would launch Bogito, they see this as an opportunity, and apparently they think that the blockchain is not permanent. They don't realize that what you do is forever etched in a blockchain. And yeah, there should be some compliance programs, and there should be audits, and none of it occurs. But market makers do play a role in both equity and cryptocurrency markets. They provide liquidity, they facilitate smoother trading operations, but there's a lot of responsibility and there's a lot of murkiness that comes with that. And more often than not, these guys tend to sink into the kind of gray lines of legal and ethical murk. And you want to understand the complexities of these market makers and that market making behavior, and understand that it is happening, and, be vigilant, and, just pay attention to who's on the other side of that order book. But again, use limit orders, use trusted assets on somewhat trusted decentralized exchanges. Make sure you're reading about your transactions before you put them through. Just take a little bit of extra time and be vigilant. But yeah, so that's the good, the bad, and the illegal of market making. I would say it's coming to a DEX near you, but it's already there. So there you go. Pay attention to them order books, buddy. All right. We will see you tomorrow. Brandon will be back. We'll rock and roll. Stay in school. Don't do drugs. Don't do anything. My poor insolvent drunk, strung on meth grandmother, who was a con artist, even in death, she's probably scamming people in hell. And I wish her the worst. And on that note, I bid you a fond adieu. 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 Adieu.
Terrified, wandering mind, the seams have come undone. You've been telling lies to these eyes as if they'd never seen the sun. Now you've let your guard down and your heart is exposed. Now you've let your guard down, but how could you have known that I'm the big fish round here? You're a small fish. I could make you disappear. You should know this. I'm the big fish round here. You're a small fish. I could make you disappear. You should know this. I'm the big fish. used to play, the rules were never clear. Smaller minds